When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone. Welcome to MacroEdge Radio. It's Friday. Happy Valentine's Day, February 14th, 2025. This is John Galt speaking, and we're going to dig into the real estate market in a major way today. Returning guest, and a fantastic guest, Lance Lambert of ResiClub. We had a really good discussion back in August, and we promised that we would revisit this market and everything that's happened after the election. Well, what a fantastic time to do it with the breaking news, everything that's been happening since Trump has ascended to the presidency, and a lot of weird economic data points that we're going to go over. Before I bring Lance up, and I'm going to invite him in here now to just stand by and be our guest speaker. Quick update on the markets. Dow down 163 to 44,598. S&P up $1.36 to 61.17. Nasdaq up 93 to 20,039. Somebody needed cash, so they sold gold down $51 to 28.94. Silver down 5 cents to 32.07. Copper down 13 cents to 4.64. WTI crude up down 57 cents to 70.72. Brent down 28 cents to 74.74. Bitcoin up 8.59 to 97.253. And of course, the bond market was all over the place because nobody knows if we're in inflation, stagflation, deflation, reflation, or confusion. We'll see what happens because the message from the data this week has markets totally off kilter, and that directly impacts the real estate market. With no further ado, Lance, welcome back to MacroEdge Radio.
Yeah, thank you for having me. Appreciate it.
Well, I guess we have a lot to talk about, so let's start with your estimation of the state of the real estate market, either by a regional basis or the national big picture.
Yeah, so I hate to do this, but I'm going to zoom out and then I'll zoom back in. So I think it's always good to just kind of start off by remembering everything that the housing market has kind of went through and passed through, and this kind of historic moment that we've kind of been in with the housing market. And if you zoom back to 2020, the U.S. housing market saw a huge acceleration in housing demand. And the Federal Reserve estimates, and this is a paper they published late summer 2022, they estimate that during the pandemic housing boom, new home construction housing starts would have needed to increase 300% to match the increase in housing demand that occurred during the pandemic. That's not possible, right? You can't increase new construction like that. There's like hard, almost like physics limits to it, right? With, the supply chain of windows and lumber and, having titled land and the development and all the labor, right? You can't go up from 1.4 million housing starts to not only go up 100% to, close to, 3 million, but then go over 4.5 and then go up to 6 to match this increase in demand. That's just not how housing works, and it has ever worked, right? So housing demand is much more elastic. It can move up and it can move down much faster than like the total supply of housing. And so because we could not match that increase in housing demand during the pandemic, which is driven by work from home, it's driven by the increase in demand for space as roommates decoupled, all the stimulus, all the ultra low rates, all of the quantitative easing and that money that moved into the capital markets and had to deploy into places. And so what we saw is a huge overheating in home prices, and the available inventory in the housing market as that demand roared, it just got absorbed very fast. So that huge drawdown in inventory that we saw, that was not anything to do with the listing amount coming into the market. That actually went up a little bit as there was a little more churn in the market with some homeowners, wanting to sell, buy something else while rates were really low. But the reason that inventory plummeted then is because demand was just so red hot and was just absorbing it all. And so fast forward, we go through that historic overheating of home prices, which nationally went up around 40% in 18, 20 months, and some markets up 60, 70%. And so fast forward through that, we get the rate shock. Mortgage rates go up from 3%, 4%, 5%, 6%, 7%. And then even briefly, touching into 8% in October 2023. And so all of that huge increase in home prices, that big rate shock, that was not met with any type of increase in incomes that were anywhere on par with it, right? So housing affordability, when you account for national incomes, national home prices, and mortgage rates, we've just deteriorated to levels that we haven't really seen since. Give me a second to look at the data. About
No problem.
85, 84 is about where we are. And at the worst, we were kind of like, pushing to 83 a little bit. The worst affordability ever is still, in my opinion, like 1981, when mortgage rates very briefly got to 18%, but then rolled over fairly quickly. And so the people who did take out mortgages in 81, were able to, a good number of them were able to get off of that rate over time. But so affordability is very deteriorated. And so now we're in this place where, because this huge deterioration in affordability has caused the existing home sales volume to fall really to like this floor of like, let's say 3.9, 4.1 nationally, depending on, which month you look at it and how you're looking at it. We've really just stayed there in this very constrained housing market. And now we've had some markets that, despite this huge drawdown in existing home sale volume, they've stayed fairly tight. They're not very supply elastic. They don't have very many home builders. Places like in the Northeast, places in the Midwest, these smaller, more affordable markets. And then those places also, they didn't have a lot of the pandemic boom migration, right? And so there wasn't then this slowdown in net domestic migration to those markets, and they've stayed a little tighter. Now, if you flip it, in this environment of very constrained affordability, you have some other markets that are a little bit more supply elastic. These are also markets that had a lot more pandemic boom migration, and then they had a lot more appreciation as well. And so that formula there of a bigger demand shock is that migration pulls out, and then local incomes have to depend more on where prices have gotten to. And then the fact that there is more supply elasticity. And so as that new construction moves into the market, and give me a second, I'll drop my computer.
Okay, that's all right.
So as also a lot of that new construction that's in the pipeline, builders do affordability adjustments, the buy downs. That then affects the supply-demand equilibrium as well for the market. And so some places like, Punta Gorda, Cape Coral, Austin, San Antonio, those places have seen declines in prices.
Yeah, it's been fairly dramatic in Southwest Florida, and we're starting to see that hitting Sarasota County. Overall, it's about 8%, but it's also a neighborhood by neighborhood assignment. Yes, sir. Go ahead. We've got you here, Lance. We can hear you.
Hey, give me a second. It connected to my
Not
Bluetooth.
A problem.
I need to take
That's
my
okay.
Bluetooth off.
That's no problem, sir. Go ahead. I'm just going to review real quick, folks. We've seen a dramatic price decline, but it's not the end of the world type of price decline. And we're witnessing that in Southwest Florida. One of the running jokes, because the northern counties are more biased towards Charlotte County, is why would anybody want to live in Punta Gorda? Of course, the prices are going to drop 40%. And that's exactly what's happened. Remote, hard to get to locations with limited accessibility generally lead to price declines. And Punta Gorda, which he referenced a moment ago, is unfortunately a good 40 minutes north of downtown Fort Myers, and worse when you're talking about going to Sarasota, as Northport, Florida, one of the larger communities just north of there, about 20, 30 minutes, is primarily a bedroom community. There's just not a lot of job opportunity for individuals or families in that area. It's a retirement zone. And those are some of the speculative areas that we saw boom after COVID, and we were scratching our heads in our own area. Why is this happening? It makes no sense. As hopefully Lance will get himself squared away here. We can continue on.
Yeah,
Lance,
I'm
you
good.
back?
I'm good to go now. Yeah, and so
I was
I
just
think
I was just waxing poetic about the market in Punta Gorda you were talking about, because it's the middle of nowhere and it's finally correcting back to the norm versus many of the other locations which are seeing decreases just based on the sheer volume of homes being put up for sale, like Sarasota County.
Yeah, and so I think with Florida, there's really, the overall reason that there's this vulnerability that's there in the market is that home prices just ran up so much during the pandemic housing boom. Nationally, home prices up, 35, 45%, depending on the indice and how you're measuring it. But a lot of these pockets of Florida were up, 60%, 70%, and then some of them up like 80, 90%. And so that's what created the vulnerability there. But what's actually been able to like manifest that into, some price softening or outright weakness or even some corrections and like, some of the pockets around Cape Coral and that part of Southwest Florida is really 5 different reasons. And the first is that the pandemic housing boom's migration surge to Florida has fizzled out. So during, between summer of 21 and summer of 22, there were 314,000 people on a net basis, Americans, that moved to Florida. In the most recent 12-month period between July 23 and July 24, that's just 64,000. So we went from a plus 340,000 or 314,000 to plus 64,000. So it's been cut into 1/4. And so as that has occurred, these home prices have to lean more on just local incomes with fewer of these deep pocket of people coming from up north. The second and very unique factor with Florida is what I call the Surfside condo shock. And what that really is just, you had the Surfside condo collapse in June 2021, killed 98 people. And then Florida passed these new structural safety rules that require more inspections, additional funds for repairs. And so you have this increase in the HOAs and sky high special assessments. And that's created the shock. But if you look at the numbers, and Parcel Labs did a great analysis on this, and ResiClub kind of dug into their data, is that it's the older condo buildings on the coast of Florida. And so every decade you go back, if you go from the aughts to the 90s, you see more weakness with the 90 ones than the aughts ones. If you go from the 90s condos in Florida to the 80s ones, you see more weakness with the 80s ones. And if you go from the 80s to the 70s ones, you see more weakness with the 70s ones. So that's the second shock. The third shock is Hurricane Ian. And it's not necessarily that hurricanes are like this huge vulnerability factor for housing. So like if you look at like Hurricane Harvey that hit Houston, I think it was 17, 18. You didn't necessarily see like falling prices because of it. But this hurricane, when it hit and where it hit, just helped to roll over the cycle for that part of Southwest Florida. It put just enough damaged properties onto the market. It was the third costliest hurricane ever. And then, it created just enough acceleration in the insurance shocks. And then it also, if you look at the data very closely, that's when the migration trend for that market shifted. And actually, Southwest Florida is unique and that Florida is still positive net domestic migration, but some pockets of Southwest Florida actually have net outmigration for the past 24 months.
And that's I'll verify that for you real quick if you don't mind. We're seeing that also not just based on affordability, because everyone points to our insurance, although that's coming into corrective measures right now. Another major issue that we're witnessing down here is a demographic decline, where the elderly are passing away in some of these older condominiums, and the younger individuals who are inheriting them do not want anything to do with it. They're just selling them on the spot. And this includes older homes, trying to flip them and make a profit.
And then the fourth reason for some of the greater supply-demand equilibrium shifts in Florida is that Florida is a supply elastic market, right? There's a lot of new construction, single family and multi, and a lot of that was, put into the pipeline into the lead up and during the pandemic. And so as that comes into the market and builders do these affordability adjustments, whether outright price cuts, bigger incentives, bigger mortgage rate buydowns, what that does is it attracts some of the buyers who would have otherwise looked at the existing and resale market, and then they go look at the new construction. And so that helps to put upward pressure on the resale and existing inventory. And then the fifth thing that's unique for Florida is the home insurance shock, right? Everywhere in the country, yes, home insurance has pretty much moved up because there's an acceleration in replacement cost because home prices, construction costs went up so much during the pandemic housing boom, overheating. And now, when you do have a damaged home, right, or a home's destroyed, it costs a lot more to replace it. So the replacement costs put upward pressure on insurance. Well, in Florida, they've seen, and they already had the highest premiums in the country. They've seen in the last 3 years that I'm looking at from CoreLogic, they've seen the biggest jump for home insurance. And in some counties, it's up 60, 70, 80, 90, 100, 120% for home insurance. And with Florida, they already had the highest premiums, right? So a percentage jump that is also the biggest, that's a big jump on a dollar basis, right? And unlike, prices and rates, which, mostly affect the buyer, right? When the carrying cost of home insurance or property tax goes up, that affects the homeowner as well. And, in Florida, you have a good number of people on fixed income. And so that becomes a little bit more acute. And with that shock, you also had a pretty big increase in the non-renewal rate. And it's not all because of the cost of replacement, right? There's been the hurricanes, increased disaster risk that's getting modeled in, and then also just a higher concentration of homes being built in Florida in disaster-prone areas.
Well, we'll vouch for that after this past season, that's for sure, because it has been one unbelievable mess that is starting to finally unwind and get normalized. But one of the things I noticed in the stories today, and I'm just going to start hitting them because they're all intertwined. Let's go to Texas, which is also experiencing a massive shift and also experiencing some deterioration in their markets, especially Austin, Dallas, etc. Amy Nixon, who follows along with our group here at MacroEdge, has been talking about this. It's an amazing sight watching these formerly booming areas. Do you have some background on what's happening in Texas and in key markets there?
Yeah, so with Texas, Austin in particular, in the second half of 2022, when the pandemic housing boom kind of rolls over, you have the rates move up, and you have a shift in the migration levels. Austin went into what I would call, if you look at the data closely, almost like a flash crash, where these month-over-month readings for the price indices are going down, 1, 2, 3% a month, right? And so you almost have like, second half of 2007, second half of 2009 type of move down in the prices in Austin. Now, since then, Austin, depending on how you look at the data, these different indices, it's kind of in a slow grind down. Now, in some of the data lines, you're starting to see in some pockets of the area, it kind of really flatline, or maybe in some of these areas, it's starting to be up like 1% year over year, right? And so it's no longer going down as much as it was. And it's starting to kind of like, depending on how you look at it, maybe it's a slow grind down. Maybe this is kind of the start of the bottom for Austin. But Austin home prices in the Freddie Mac house price index for the whole metro area is down about 16%. And in the Zillow home value index down about 22, 21%. And then I would say most of the other indices are kind of somewhere in between that for Austin. And if you look out at the, county and zip code level data, what you will see is it's really these deep exurbs where they built the most homes, and there was, just a lot of appreciation in those areas. And then, they're a little more supply elastic, right? As that supply kind of moves into the market, the demand has really shifted to a different place. They've had to do the affordability adjustments. And in Austin, it's not just buy downs. Some of the builders that I know actually did 20% cuts like overnight in Austin in the second half of 2022. Like, so what they did is instead of like slowly meeting the market, they just went and jumped right and tried to find the market very quickly. But still, a lot of that was in the second half of 2022. And I think now it's, I would kind of describe it as choppier, but not necessarily what it was then. Whereas like Southwest Florida and these areas are like, and I know I'm pronouncing this wrong, Punta Gorda and then Cape Coral, those are places that were much more in correction mode through last year with faster move downs in price, whereas Austin, a lot of it was like second half of 2022. But the weakness in general with Texas relative to these other states is one, the like I said with Florida, where the migration during the pandemic housing boom was very big, right? Going up like 300,000 for Florida and Texas between summer 21 and summer 22. And then now it's like, it's like plus 60, plus 70, plus 80 kind of range. And so there's still positive net domestic migration to Florida and Texas, but not like it was before. And so that means the local incomes have to support more of these prices. There was more price growth in Texas and Florida during the pandemic housing boom, right? So that creates some of the vulnerability. And then the other factor is higher carrying cost as the property taxes kind of go up. That's an impact to homeowners. And then, like I said, with Florida, greater supply elasticity because there is that home building presence. And as it has to move into the market, the builders will move, they'll do affordability adjustments, take a hit to margins to maintain volume.
Now that brings up the next question, because we've seen the inflation report for CPI and the adjustments in PPI also this week. And it appears that we have an embedded inflation problem, even though there's some rotation with energy, food, et cetera. But we're starting to see higher cost for residential construction materials. And we're also seeing persistent problems with not just homeowners insurance, auto insurance, et cetera, really beginning to pile on potential first-time home buyers with a lack of innovative starter home solutions in the hottest areas or most desirable areas of the country. At what point do you see a resolution for this, or is there one? Will it take a natural decline in sales to meet that need?
Well, so when I look at the data and I closely track the earnings reports of these different builders, I think what you will see is that since the pandemic housing boom, when there was the very big, like historic margins, right? They pretty much had full pricing power. They had huge margins on what they were selling. They had bought it at lower land values than what they expected home prices to be, and so margins got very big, right? What we have since seen happen is we've seen this like slow grind with margin compression, and the profit margins are slowly coming off of those highs. Some of that is I think in some of these areas where there's like these affordability concerns and some of the stuff I talked about earlier with like Florida and Texas, how they've gotten these bigger demand shocks. But some of it could be from some of these material costs, right? And so, but the thing is, where the margins are right now, at least with the big builders, right? It's still in a place where they're doing the volume, like they're maintaining the volume and they're continuing to build. But if you got the margins compressed to some level, right, there becomes that point where, it would take a hit to activity more for single family home building. But so far right now for the big builders, I don't think we're there.
That makes sense. And what we're seeing in Southwest Florida, in Punta Gorda, in Northport, in parts of Sarasota County, Cape Coral, et cetera, the smaller builders are replying back with the concept of build to lease, which phases us into the next question, because you noted this also in one of your posts. And by the way, Lance, ResiClub is definitely one of the must follows on X. If you're one of the FinX people, you must follow Lance Lambert if you really want to get a good flow of information of what's happening, different aspects. What is your perception of JP Morgan entering into the build for landlord aspects of the market? That's an amazing development, in my opinion, for a bank of that size, much more so than a Blackstone or some of these other investment groups.
Yeah, so if you zoom out, what you'll see in the data is that during the pandemic housing boom, we had a really big acceleration in institutional capital that was moving into by like scatter site homes, right? And it was moving to build to rent as well. But when the rate shot up, financial markets shifted, they've really pulled back hard on the scatter site home buying. That's went way down. I do a conference annually in November in New York City called Resi Day. We had a representative there from Roofstock that helps a lot of these, institutions deploy capital, right? And helps them buy homes through the MLS or however. And they said that like American Homes for Rent and Invitation And I asked him this multiple times just to make sure he was right. They said they haven't bought a home in the MLS in almost 2 years, right? And so they are still buying some homes here or there, but where their activity really is on the institutional side, it's built to rent. And so while you've seen this really big pullback in scatter site home buying, build to rent, they're still like, that asset class isn't as hard hit as I think some people had pointed out. And I see him on here, Kevin Erdman, and he's really somebody who's called this, but there is still a good amount of activity out there in build to rent. Now, when I've talked to some of the hard money lenders and some of these other, players in the space, there's not as many of the, billion-dollar deployments that we saw like in 2021, but there is still some activity out there for build to rent. And
Do
if you
you
want
think
some,
that
we're
oh,
up.
go ahead. Go ahead.
Yeah, according to Yardi Systems, I was looking at the data, and I'm actually going to send out a report today on build to rent to my pro members. We're at about 107,000 units build to rent. The biggest is in Phoenix by far, then it's Dallas, and then it's Atlanta. So it's still a lot of the Sun Belt areas, but really the Southeast is where it's the biggest. And there's a good presence in Florida, Carolina, Charlotte, and even places like Huntsville, Alabama as well. And so build to rent used to be around, I think it was 1.6 of all housing starts for single family back in 2005. By 2020, it got up to like 4.5%. And now we're up to like 9%. And I was looking at the National Association of Home Builders quarterly report, and it's still around 9%.
That's an impressive number. Do you see that with the lack of desire, it would appear with the Gen Z to take on home ownership or develop large families per the traditional American model? Do you see this becoming an expanding market, possibly into the 20% plus range in the next decade?
I think like when you go through and you look at their investment, like when their their investment thesis is that there wasn't enough like of this middle built and this lower end rental. Or there, a certain segment of the single family market just wasn't built as much as you would have expected, given what happened in GFC and following it. And so their, business plan is to build like this middle of the market, right? These cottages, these townhomes, this kind of single family that would be for somebody who would kind of be like normally an entry level buyer. And now they're kind of like, a renter who's, they're not like the beginning of the rental experience. They're kind of more now in like their 35 to 40 or their 30 or they're like 25 to 30, like kind of in all of that pushing up. And that's the specific part of the market they're targeting.
Well, that makes sense. I think there's an investment opportunity there versus the speculative, no money down seminar buyer, which I think might get squeezed out of the market by the institutions. We're seeing a lot of these cowboys, for lack of a better word, that we've had flow through the Florida markets going down quickly. And I think that the short-term rental impact, a lot of the communities banning them, is also adding to inventory, but also perhaps giving us some price correction relief in several markets.
And the local stuff, what are you talking about there that you're seeing?
Well, we're seeing a lot of communities are banning short-term rentals, especially
short-term rentals. Okay. I
yeah, and that created
an.
No. I'm sorry. I'm talking about short-term rentals and the investment speculation that accompanied that after with the Airbnb boom bust cycle that accompanied after the pandemic. We saw a major increase in it, and of course the extremes of the Airbnb cycle. There's been a reaction by communities, towns, counties to ban them to some degree, except for long-term 90-day plus rentals. That's putting a little bit more inventory back on the market also as people speculated on the return to the old days of STRs. It sounds to me more like institutions are going to start setting up funds specifically for the build to rent or acquire to rent aspects of the market. Is that what I'm reading into this correctly?
Yeah, there's going to continue to be deployment from the institutional and capital markets into build to rent. And how that kind of looks like is probably a lot like how you see with this JP Morgan asset management, right? Where they team up with developer and the builder and they kind of create a division to do it. Like that's kind of where you're looking at, where it's like JP Morgan is bringing like the institutional capital, right? And then, they're teaming up with, the builder and developer who kind of understands those markets and, has, the contractors, general contractors, subcontractors, and all of that. But yeah, you're going to continue to see that. And even if, we were to see some type of rollover here in build to rent completions, which, people kind of keep talking about, but we're not quite seeing in the data. Even if that happens, build to rent is going to be here to stay. As long as it's not, legislated out.
I can't. Well, there's been talk about that in Florida and in Texas, so it has me curious as to whether that's going to really gain any traction, because we have a housing need, but the build to rent market actually does accommodate that, in my opinion, and does provide an option, if you get my drift, because people do not want to buy a home every time. I'm going to ask a question on behalf of one of our listeners, GBR. What's your hypothesis for why the NAR's metros with largest home price increases are some of the most dangerous cities in America? I assume this isn't purely a case of low basis.
Yeah, so a couple of things there, where the fact that a lot of these areas of the country that have seen the most depreciation over the past couple of years are a lot of these, smaller, mid-sized cities in the Midwest, Northeast, some places you would never think of as leading for appreciation. And I think there's a few factors. I think one is they don't have much building, right? There's not, much development there in terms of home construction, so they're not as supply elastic. And when you move into this constrained affordability environment, some places in Florida and Texas have seen these builders, cut prices, do affordability adjustments, bigger buy downs to maintain volume. And you don't see that in places like, Zanesville, Ohio, right? You don't see that in places like Harrisburg, Pennsylvania, right? They don't have as much home building. So they don't have that, supply elasticity, and they're not getting, pretty much existing in resale is the only game in town, right? And so I think that's a part of it. I think another part of it is they didn't see as much out migration during the pandemic housing boom, whereas let's say, or they didn't get as much inbound, really. Or either way, right? They were more stable on their immigration levels in terms of the migration. And so because they were more stable there, they didn't get as affected when that rolled over, right? So places like Texas and Florida, they saw a lot of migration coming in during the pandemic housing boom, but then that rolled over and created a demand shock, and prices had went up there more. And so then they had to be more reliant on local incomes. Whereas these places in the Northeast, Midwest, that didn't happen.
And with that, we'll take a quick break, folks. MacroEdge.net/ozone, MacroEdge.net/ozone. Get the 2-week free trial. Try and sign up for it. Follow the great information that's being relayed by everybody, including the MacroEdge ResiClub team. And of course, you get to listen to great guests like Lance Lambert and others who bring you perspectives you don't hear in the mainstream. And you also get an opportunity to form your own opinions for analysis. Lance, please plug your website real quick and how to find you on social media before we go into the multifamily fun.
Yeah, so, and multifamily isn't as big of my thing, just to give you a heads up. But if people want to follow me, obviously you follow me here on Twitter @NewsLambert. And then if you want to sign up for my newsletter, go to ResiClubAnalytics.com. And just when you get to the page, and if you don't remember the URL, just type into Google ResiClub. You'll go to my website, put in your email, and you'll get signed up into my free list. You can also follow me on LinkedIn at Lance Lambert.
Fantastic. The reason I'm bringing multifamily up, a lot of the areas which are experiencing price declines have had oversaturation of multifamily building. Has there been any analysis of the oversaturation versus single family price declines and any noticeable impact that you can cross correlate with that?
Well, I think when you look at the numbers, you do see a market like Austin that has had, they kind of stick out for multifamily and single family, whereas some markets you kind of run the numbers and they're more multifamily. You run the numbers and they're more single family. Austin is one of those unique ones that kind of had a good amount of both. And I think you do see, of course, the weakness in the multifamily market. But a lot of what the weakness has been created there is still a lot of what I talked about earlier, right? The greater demand shock from affordability running up faster there, right? Because prices ran up faster. And then the fact that migration has rolled over, that has affected the single family and the multifamily market there.
That brings us over to the condominium markets, which we've seen, like you were talking about with the turfside effect, which has impacted a lot of the older residents and condominiums in our state. When you take that across the spectrum to other states and a lot of the conversions that we're seeing attempted, it seems like there's a large volume of unnecessary condominiums being brought onto the market to compete with single family homes, which I think is actually hurting affordability for single family homes. You could probably provide cheaper development of single family homes if we weren't building so many blasted condominiums in some of these regions. Is there another correlation there in addition to the multifamily apartment side of it?
Yeah, what I can say is based on the data, and anybody could go download this from Zillow, is that you see nationally more weakness, of course, in multifamily and apartments and all of that versus single family. But also when you do home prices, if you take single family and put it to the side, and then you do condos, you'll see there's a lot more weakness in condo prices right now than single family. And it's one of the reasons that when you look at the Zillow Home Value Index, it's nationally, it's, in my opinion, seen a little less, and this is my opinion, meaning this is why I think that it's seen less appreciation. But the Zillow Home Value Index has seen a little less appreciation than like the Freddie Mac, which is just single family, than Case-Shiller, which is just single family. And so we do see that there's more weakness right now in condo prices versus single family. And then if you go to Florida, of course, 92% of all metros and micro areas in Florida are seeing falling home prices for condos. And it's about 60% of Florida markets that are seeing falling home prices for single family prices. So definitely more weakness for condo nationally than single family. And in Florida, a lot more weakness for condo than single family.
Fascinating. I was hoping we would see a greater deterioration in condominium prices because they really have overdeveloped that aspect of the market. But I'm only speaking for Florida people. I can't speak for any other market. It's an amazing sight to see the number of condominiums for sale in our region. Let's move on to something else that hit from the National Association of Home Builders. Credit for builders is tightening, and this is from a story today by Paul Emmerich at the NAHB. Are you hearing of problems with access to credit for builders? Obviously, the big boys are not having a problem raising capital, but the small and intermediate sized custom home builders, are you beginning to hear echoes of issues like that, like we heard last before the GFC?
Yeah, so what you're seeing is that smaller builders are being affected by, and this has actually been the case for a while, and really even dating back before and following the Silicon Valley bank collapse, the smaller builders have had a harder time, right, accessing credit versus the big builders. And so that's been a little bit of the effect on the smaller builders. And then the other factor is these publicly traded giant home builders like Pulte Group, they have their own in-house mortgage company, right? A lot of them strategically went out and either built them or bought up mortgage companies and made them their in-house mortgage company. And so by doing so, they've been able to deploy incentives in a way that's been a little more useful for them, like these mortgage rate buy downs that they were very aggressive with. And so big builders were taking share from small builders for, multi-decade, right? Period. And that is only accelerated recently. And so we've gone from this period where, 3 years ago, the publicly traded builders had around 38% of the market share. And now they have about, 53, 54%. And Zonda's chief economist, Ali Wolf, she told me that's going to 60 pretty soon. So you definitely see some choppiness for the smaller builders relative to the bigger builders.
Well, do you agree that there was a commentary about this? The housing supply hits 5-year high, but buyers aren't playing ball. Do you think that the prospective home builders, which I would say are probably in the 30 to 45 range, although the elderly are also being captured as they relocate to their retirement destinations, they're going to try and hold out for lower interest rates and the idea that we might see a return to 4.5% mortgages, and that might impact the price declines even further, especially in the Sun Belt.
So is your framing there that as the lock-in effect eases and some of the homeowners who, kind of wanted to sell their home to go buy something else, as they come into the market and that new inventory comes in, that would put downward pressure on prices? Is that kind of your gist?
Yeah, correct. I think a lot of people are waiting for lower mortgage rates, not just buy downs, but also short term, long term. A lot of retirees have put off moving to Arizona or Florida, Texas, et cetera, waiting for the lower rates and better prices. So they might hold out for a year or two as the inventory grows, figuring that would put the pressure necessary, plus the actions by the Treasury, et cetera. We'll talk about treasuries and banks in a minute because that goes back to a question from our last show. But I'm beginning to wonder if the consumer is actually drawing a line in the sand on affordability and saying, we can't afford a 7.5% or 7% mortgage. We're going to wait, and we'll wait 2 or 3 more years instead of pushing a button now.
Yeah, and so this is a little bit of like Mark Zandi's theory of weakness creeping into housing over time, given the fact that we haven't seen this, significant improvement in affordability, right? And then we're in this very constrained affordability environment. And so Zandi's view has been that over time, as some of those people kind of have to sell, that you would start to see some of that greater weakness come into the market. And maybe you've seen just a little bit of that over the past, 12 to 14 months versus like that tightening up that we kind of had in 2023 after having that really hard, rollover in the second half of 2022. Maybe that is why, we've seen some of that more of that inventory build last year and kind of, some of the not falling prices, but decelerating prices in more of the markets. Now, there has been the places that have been falling, but I'm saying some of the deceleration in the places. That's a theory, but one of the issues with that theory is that if these people are unlocked from the lock-in effect, they would also become a buyer, right? Because the only people who are locked in and not selling to buy something else is because they're worried about, losing that lower rate, that lower monthly payment, and then taking on a lower rate and losing the lower monthly payment and rate and taking on a higher monthly payment and rate. And so the reason they're not doing it is because they don't want to sell and take that on. But so if they're unlocked, they would sell and go buy something else. So there would be, one additional home for sale and then one additional buyer. Uh, I think, I think the big thing there, if you're trying to like create a downside risk for housing, it's less of an easing up of the lock-in effect. Because like I just pointed out, it would, it would bring supply, but it would also bring demand. I think if you're trying to create a downside risk for housing, it's really the R word. It's recession, right? It's if we do, if this period of, elevated rates, right, and being restrictive for so long, if that starts to create, economic contractions, right? Let's say the banking side of the economy has issues from the commercial loans, right? And if we were to go into a recession, well, given how constrained affordability is and the affordability pressures, I think depending on how things unraveled, right? And what different other shocks came with it, I think some markets could be vulnerable, especially some of the submarkets, some of these short-term rental submarkets or some of the boom towns that haven't necessarily seen rollovers as much, like Charlotte and like Nashville. And I would have also put Tampa in this, but you're starting to see that weakness already start to come in for Tampa now. But I think more of the downside risk for some of these markets would be how do they fare if we actually get recession?
All right, I'm going to bring Jimmy the Otter up. He has a question, one of our listeners. Go ahead, sir.
Thank you very much. I saw the J.D. Vance speech. I was wondering your thoughts on how it's going to affect the economy.
If you're referring to the speech in Germany, I don't think it's going to have any major impact on the economy at this time. We're more concerned in this particular aspect of focusing on residential real estate. And that's something where
surely reducing Europe's dependency on America and increasing the military spending will have a direct effect on residential real estate in the long term.
Well, over the long term, yes, it might have it, but the reality is that there's more impact, and I'm going to get Lance's opinion on this right now, with the tact that Scott Bessent is approaching and going to sit there and focus on the 10-year, which I think if we can bring the 10-year under the magic 4% level might be more positive for housing in the long term. Would you not agree?
Yeah, so all things being equal, right? If you have an environment where the 10-year and these long-term yields and rates come down, including mortgage rates, all things being equal, you're going to see more churn in the existing market in that lower rate environment than you would in the higher rate environment, right? And we've seen this at times where sometimes, the average 30-year fixed mortgage rate will kind of slip down, gets closer to 6, and you start to see just a little bit of a little bit of a life additional activity kind of start to rear its head. But what you really need there is you need a duration of rates coming down, because somebody who's going to sell their house to buy something else, and that is the specific part of the market that has really been pulled back since rates shot up a lot, because they don't want to give up that lower monthly payment, lower rate for something much higher. For that person to actually, feel confident enough to sell their house to go buy something else, you need rates to have come down a bit for a little while, because then they're like, okay, rates have come down a bit. This math kind of works. The numbers kind of work for me now. I'm going to sell my house. They sell it. They go buy something else. What they don't want to do, or they feel less confident doing, is if rates come down just for a second, but then they feel like they're maybe going to shoot back up. And that's why you need that duration, because it takes a little bit of time, right, for somebody to sell a house and then go buy something else. But I do think the churn of the market, it takes time, and it's going to be a slow grind to get back. But one of the things that would, of course, increase it, and maybe not too fast, but maybe it's just, a little bit, is rates coming down a bit and the 10-year treasury yield coming down. But it's probably going to be a slow grind to get existing home sales back up. And right now we're at around like 4.1 million. Of the 16 forecast models that I track for existing home sales, the average expects by the end of 2025 for existing home sales to be averaging on a seasonally adjusted annualized basis 4.2 million, right? 4.22 million. So that's only going up about 100,000 homes additional for existing home sales. In other words, that's really just flat, right? And so before the pandemic occurred in 17, 18, 2019, we were doing about 5.3 million existing home sales transactions. And then during the pandemic housing boom, as we kind of get some people who are like, what, rates are really low, honey, let's sell this house and go buy, down in Florida or Texas, where we've been wanting to get to. You saw existing home sales move up to 6.1. And then as soon as rates shot up, you had what the lock-in effect was come into play. Existing home sales really crashed hard in the second half of 2022. And they smacked into what I call a trough here for existing home sales. And so existing home sales, you'll hear people, talk about one report being up, or maybe they'll talk about one report being down. I know CNBC is really bad about this. If you get a mortgage purchase application that's kind of looking high for a week, they'll write a big headline, mortgage apps are spiking. But really, if you look at the data for existing home sales and you look at the data for mortgage purchase applications, we've been on a long trough since the second half of 2022 when we smacked into like that 4 million level on an annualized basis for existing home sales. And we've just been kind of stuck here. And every time somebody thinks that we're starting to recover, it falls back down, right? So I think it's going to take time to kind of work into that. And I think it will take some of the accumulation of lifestyle changes for people where, part of the big reason that some people aren't selling to buy something else is because of, the fact that rates have went up so much and their payment would jump up so much. But as people kind of wait that out, lifestyle things happen. Maybe they live in a 2-bedroom house and now they have 3 kids, right? And so the wife's starting to get a little unhappy with them. And that psychological cost of maybe your wife isn't happy with you, it's causing stress on your relationship. All of that is the psychological side of switching cost. And over time, maybe if also their income comes up a little bit, but they're willing to be like, you know what, it'll give me peace of mind, sell this, buy something else, even if I'm having to get a payment that's, $800, $900 more per month. So over time, you have these things that occur that will start to create more churn. But yeah, like you asked, John, if we got lower rates, that's the easiest lever that kind of can get more activity going for existing home sales.
Fantastic. Arc Signal has a question for you, sir. Go ahead, Arc.
Hey, good afternoon. Can everybody hear me okay?
Sounding good, sir.
Yep.
Go ahead.
All right, thank you. Hey, Lance, can I ask you a question, sir?
Yep, hit me.
Okay, thank you. So I think it was probably 2 or 3 days ago. My timing may be a little off, but there was a segment I was watching with Jerome Powell, and he made mention to something of the effect, and I might be a little off, but you'll get where I'm going. He said something to the effect that in the next 2 to 10 years, with the coastal states, he didn't specifically say what state or states, he just said coastal. He said over the next 2 to 10 years, he's like, you're going to see mass just these mortgage companies leaving, insurance companies leaving just in large numbers. So if it's okay, if I may ask you, what is your trend or what is your projection do you see with that type of information with residential housing in these coastal states as what he said? And thank you.
Yeah, so I've been doing a lot of digging on this topic. There's somebody that I had come out to Resi Day called, he's the Chief Analytics and Data Officer at CoreLogic. His name's John Rogers. If you don't follow him and if you're on LinkedIn, he's a really good follow for home insurance stuff. But he has a team of 200 meteorologists and data scientists at CoreLogic, and they analyze the risk assessment not just by market, but actually every individual property in the United States, residential and commercial. And they do their risk assessment on these different properties. They sell this data then to insurance companies, and insurance companies use it, it's a component in how they decide where premiums go, right? And so I think this is a concern for them, where some of these different properties in the U.S., the insurance risk is just very high, right? Some of these pockets of Southern California due to fire risk, some of these pockets of Florida due to, potential wind damage and hurricanes. And so you also then have a group called First Street, and they've been doing risk assessments regionally, and they've been trying to figure out where they think home insurance premiums are going. And so I'm going to publish data this weekend for ResiClub Pro members looking at every county in the U.S., First Street's estimate for where home insurance they think will go between 2025 and 2055. And so in a lot of markets, they think, it's not going to move up too much, right? And, on a real basis, right? But then there's other markets where they think, some of these pockets of Florida, some coastal parts of like Texas, some of these areas of Southern California, where it could go up on a real basis like 300%, right? And so that's not even starting to factor in what could happen, for additional inflation that it could occur between now and then. Because additional inflation, obviously, that would feed over into insurance as well as cost of replacement moves up. But it's definitely a risk out there, but it's also something that I'm trying to figure out how to quantify, because it's a little it's speculative, right? Trying to figure out what would potentially happen, 10 years, 20 years down the road, 30 years for home insurance. And, how do we know these risk models are going to be accurate, right? Um, but it's definitely, if you had me list out like what are my biggest long-term concerns with housing, it's like one or two, maybe one.
Very good. I got one more question from a listener. Jakir is going to join us here. Jakir, you there?
Yeah, I'm here.
Please ask your question, Lance.
Hi, Lance. This is Zakir here. I'm just curious. Most recently, a new administration they're firing so many in Northern Virginia and federal worker, right? So, do you have any insight what's going on in down the road next 6 months in Northern Virginia or Maryland, DC area? Because of in Prince William County or Alexandria in Ashburn, Loudoun County, their pricing is so exuberant amount of pricing. You know that, right? So, what's your data suggested in next 6 months or next 1 years? If you can have any insight, please.
Yeah, so DC is one of the more interesting housing markets on the East Coast that's not in the Sun Belt. The reason is what you've seen if you look through the data closely is that the suburbs and the deep exurbs and deep exurbs as well of Washington, DC have been red hot for the past 24 plus months, even since the pandemic housing boom ended. And a lot of that is kind of like that donut effect where, maybe some of these places don't have as much fully remote, or kind of they're worried that over time fully remote will go away. So they still want to be in the market. They're not going to go to Austin or Boise, but they're also like, you know what? If I don't have to do my commute every day of the week, maybe I live somewhere that's within, I could handle 1 to 2 days to go into the city. And that's also true for New York City. It's also true for Boston, where these deep exurbs of the Northeast, even during this period where rates have gone from 3 to 7%, have really stayed tight and prices have moved up a lot. But then if you go into downtown DC, into these different, condo areas of the very urban core of DC, they've been very weak and prices have barely moved up compared to pre-pandemic levels, which is kind of a crazy thing to say to a lot of people across the country who followed housing, because so many of the places of the country are up still 40-50% above pre-pandemic levels. Now, in terms of how the market reacts to all of this, at the moment, I've gotten some DMs and I shared some of those last week of people saying, hey, we've seen a change in activity, right? Since some of the stuff has been announced, especially with like the Doge stuff, it's kind of scared people. And then I've had other real estate brokers kind of chime in and say, hey, Lance, I haven't seen any of this. It seems like normal kind of seasonality at the moment for me. In terms of the data, I haven't really seen much of a change there at the moment. But if I had to draw out these two, the headwind to the DC market would be this Doge, right? The talk about actually cutting federal headcounts significantly, right? And how if that were to actually occur, and how courts would affect it, and can a lot of this be done without legislation? Those are all like big questions to go with it. But the theory of if there were a lot of cuts to federal headcounts, that would be, I would consider that a headwind to the market, right? If that actually manifests. Now, on the other side, there's a potential tailwind, right? And that is if all of these federal workers are actually brought back to work, more of them who've been remote. If that were that is actually happening, and that is within the power to do, but depending on how that played out, that could start to create some tightness in some of these parts of the urban core of DC that have really been weak over the past few years. And so that's how I'm kind of observing the market there, is I'm going to do what I always do, which is kind of wait for commentary of all these great sources I have across the country who are local professionals to tell me what they're seeing. Two, it's to follow the active inventory of the market, that I do from Realtor.com data, and I send out to my ResiClub Pro members, and then also follow what's happening with home prices as well, and then kind of monitoring what I consider the headwind to be and how that plays out, and then monitoring the tailwind, which is that potential pullback into the office.
Well, I'm going to close the show out with a big question, because last time when I hit you with a big question in August, I think we're all in a little bit of disbelief that it was possible. I've read some reports where the removal of conservatorship for Fannie and Freddie could possibly result in a 0.5% increase, 50 basis point increase in mortgage rates if they become private entities. I've also read where it might stimulate competition and demand for mortgages even more broadly, even if it was only a quasi-government backing of their paper. What is your opinion of the consequences of this potential removal now that we're approaching a reality within the next 6 to 12 months?
Yeah, so I published a report for ResiClub Pro members on February 10th about what would happen to mortgage rates if conservatorship for Fannie Mae and Freddie Mac were to end. And actually, which is kind of funny, somebody over that's in the administration reached out and wanted that report right away within a few minutes of it going out. What we've seen in the financial markets is that as soon as Trump won, you saw a huge spike in what are almost dead stocks of Fannie Mae and Freddie Mac, right? And then recently we've seen another jump up. And so now those two stocks are up about 400% plus since Trump won. And so I think that's kind of a sign from the financial markets that they think this is possible, right? It could very well happen. And so I reached out to Mark Zandi, Moody's chief economist, who's published a few different reports on this, one back in 2017, and then one just a few weeks ago. And I asked him for the different scenarios that we could see play out and how those would impact mortgage rates. So if we have a second, I'll actually go through all five. The first one is Zandi says conservatorship status quo remains in place, and that he gives a 65% probability. The second one is the release of Freddie Mac and Fannie Mae with an implicit government guarantee. And so he says that is a 20% probability. And in that scenario where Freddie and Fannie Mae are released with an implicit government guarantee, he thinks that mortgage rates would go up 20 to 40 basis points. So right now we're at like 690. We're at about 7% for the average 30-year fixed mortgage rate today. Zandy's saying we would be like 7.2, 7.4 as that spread kind of widens, and he gives that a 20% probability. And an implicit government guarantee is that the government does not explicitly commit to backing the government-sponsored enterprises, which are Fannie Mae and Freddie Mac, but the market assumes it would intervene to prevent failure, right? And that's what the case was before the 2008 financial crisis, where governments financial markets and investors believed the government would rescue the GSEs if needed, which is what happened. But since there's no formal guarantee in that scenario, it can still lead to higher borrowing costs as investors demand extra compensation for uncertainty, is what Mark said. Now, the third scenario is a full release of Freddie Mac and Fannie Mae without either an implicit or an explicit government guarantee. And Zandi gives that a 10% probability. And this is the scenario where if the government released both, doesn't do an implicit or an explicit guarantee, that's where the average 30-year fixed mortgage rate, Zandi says, would jump 60 to 90 basis points. And so that would be going from like a 7% average 30-year fixed mortgage rate to 7.6% or 7.9%. And give me a second. And so in that scenario, the government-sponsored enterprise share of the mortgage market would significantly decline, and we would increase private lenders in the FHFA, resulting in greater taxpayer exposure as taxpayers bear all the risk in FHFA loans, is what Zandi told ResiClub. And then the fourth scenario is a release of Freddie Mac and Fannie Mae with an explicit government guarantee. And that's the scenario. And explicit means the government comes out and formally guarantees, the government sponsors, the GSEs, which are Freddie Mac and Fannie Mae, explicitly guarantees their obligations if something were to go bad. And Zandy, again, gives that a 5% probability. And that actually is a scenario where Zandy says mortgage rates could fall as much as 25 basis points if that were to happen. So that would be going from a 7% to like 7 or to 6.75%, using today as an example. And then the fifth scenario that Zandy gives is he says Freddie Mac and Fannie Mae are fully chartered as government corporations. Zandy gives that a 0% probability because you'd have to go through legislation as well. And it doesn't look like that's what the Trump administration wants to do either.
Makes for a fascinating next 6 months, does it not, sir?
It does. And happy to come back anytime. Really excited what you all are building with MacroEdge. And if anybody, ever has any questions with housing, feel free to reach out.
That is Lance Lambert. And if you're not following him on X, it's at News Lambert, Lambert. And his website is ResiClubAnalytics.com. Check it out, folks. And don't forget to check out MacroEdge.net/Ozone, MacroEdge.net/Ozone, 2-week free trial. Next week, yours truly will be making it up to his wife, not taking her out on Valentine's Day for a little 3-day weekend vacation. I shall see you guys 2 weeks from today. We will have a guest host next week and a new program for MacroEdge Radio. This is John Galt. Good night now.